All right, let's dive right in. Today, we're going to pull back the curtain and deconstruct a professional trader's playbook. We're talking about India's Sensex index, and more specifically, what the game plan is for the day after a massive market drop. This is where the real strategy comes into play. So let's get to it. So, this is the million-dollar question, isn't it? The Sensex just took a nosedive. What do you do tomorrow? And look, this is not about gazing into a crystal ball, not at all. It's all about being prepared for what could happen. And the only way to do that is with a rock-solid plan. Okay, first things first. Before you even think about placing a trade, you have to figure out which way the wind is blowing. Is this a moment to be brave and buy the dip, or is this the start of a much bigger slide? This is what traders call establishing your bias. And boom, there it is. The answer is crystal clear. The core strategy here is to sell on rise. Let that sink in for a second. The game plan is not to be a hero and buy this dip. Nope, it's to sell into any bit of strength, any little bounce. The expectation is that any upward move is basically a trap, and it's likely going to fail. But the big question is, why? Well, the plan doesn't just pull this bearish idea out of thin air. It confirms it by looking at the market from 3 different zoom levels. On the hourly chart, the price is way below all the key moving averages. It's just screaming downtrend. Then you zoom into the 15-minute chart, and what do you see? That classic pattern of lower highs and lower lows, which confirms the trend. And that little upward tick on the 5-minute chart, the plan just sees that as a short-lived relief bounce, not a real reversal. You see, when all 3 time frames are telling you the same story, that's a really, really powerful signal. But hang on, here's where the professional thinking really kicks in. The plan acknowledges that the RSI, a key indicator, is oversold. What does that mean in plain English? It means the market is stretched to the downside, kind of like a rubber band pulled too far. And that means you can get these really sharp, aggressive bounces out of nowhere. An amateur might see that and think the bottom is in. But the pro, they see it as a golden opportunity to sell. Okay, so our bias is bearish. We're looking for spots to sell. The next logical step is to map out the battlefield. We need to identify those key lines in the sand where the buyers and sellers are most likely to go to war. And here they are. On one side, you have your immediate support levels. Think of these as potential floors, like 72,000 or 71,900, where buyers might try to make a stand. On the other side, you have immediate resistance. These are the ceilings, like the 72,180 to 72,250 zone, where sellers are probably just waiting to pounce. A trader's job is to plan their actions around these very specific zones. Now, out of all those numbers, there's one area that is absolutely critical. We're talking about the zone between 72,330 and 72,380. The plan flags this as the first serious supply zone, where selling pressure is expected to be really strong. This spot is the focal point for the entire strategy. So, how do we turn all this analysis into something we can actually trade? This is where a professional plan shines. It isn't a single prediction. It's a set of if-then statements that prepare you for multiple outcomes. All right, here's the A-plus setup, the highest probability scenario. The idea is to be patient. You let the market bounce up into that first resistance zone, but, and this is key, you don't sell right away. You wait for a clear sign of failure on the 5-minute chart, like a bearish rejection candle. That tells you the sellers are taking back control. That's your trigger. And just look how everything is defined: the entry zone, the trigger, a stop loss to manage risk, and multiple targets to take profit. It's all laid out for you. So why is this considered the best bet? It's simple, really. You're swimming with the current, not against it. It aligns with the dominant downtrend. And it's based on market psychology. It anticipates that classic institutional move of letting amateurs buy a small bounce, getting them trapped before pushing the price lower again. But hey, what if the market is so weak it doesn't even have the strength to bounce? That's where scenario 2 comes in. If the price breaks down below the 71,900 support level, the plan is not to chase it down. That's a rookie move. Instead, you wait for a small retest of that broken level. If it fails to get back above, that becomes your entry. It's a much safer, more calculated way to trade a breakdown. You know, any good plan has to account for being wrong. And that's what scenario 3 is all about. It lays out the only conditions under which you'd even consider a bullish trade. The market would have to do something really impressive. Not just touch, but decisively break and hold above that critical 72,380 resistance zone. Only then would the evidence start to suggest the tide might be turning. And here's the reality check. The plan makes it absolutely clear. This bullish scenario is plan B, maybe even plan C. It's a long shot. This is crucial because it keeps you focused on the highest probability outcome without getting caught completely off guard if the market throws a huge curveball.
Having a strategy is one thing, but executing it is a whole different ballgame. This part of the plan gets into the real nitty-gritty of how to place the trade, especially during the chaos of the market open.
To do that, the plan recommends a specific options strategy, a bear put spread. Now, don't let the name intimidate you. In simple terms, it's just a way to bet on a downward move while controlling your cost and your risk. It's actually perfect for a sell on rise scenario where you're expecting a controlled decline, not a total market crash. Let's look at a concrete example. You'd buy the 72,200 put, which makes money as the price falls below that level. At the same time, you'd sell the 72,000 put. Selling that other option brings in some cash, which lowers the total cost of your trade. It's a clever, defined risk way to act on that bearish view. We all know the first 15 minutes of trading can be absolute chaos, so this plan gives you a simple, rule-based playbook. If the market gaps down, don't panic and chase it. Wait for a bounce to sell into. If it gaps up, watch to see if it can hold its ground. If it opens flat, just be patient and wait for the market to show its hand. No emotion, just rules. Okay, for the last piece of the puzzle, let's look at this whole setup through the lens of the big institutional players, the so-called smart money. How are they probably viewing this? Understanding their playbook can give you a real edge. This is the story behind the sell-on-rise strategy. The big institutions might actually let the price drift up a bit in the morning. This does two things for them. It lures in hopeful buyers who think they're getting a bargain, and it forces early short sellers to panic and cover their positions. Once enough buyers are trapped, they can reject the price at resistance and push it back down. And where are they pushing it to? They're heading for where the liquidity is. These support levels we've identified aren't just lines on a chart. They represent huge pools of buy and sell orders. The big institutions are likely targeting these exact spots to fill their large positions, which, surprise, surprise, aligns perfectly with the profit targets in our primary trading scenario. So after all that analysis, it all boils down to this one simple, clean execution plan. This is the synthesis of everything we've talked about. If the price gets into that key resistance zone and shows weakness with a bearish candle, you sell. Everything is defined, removing any guesswork when you're in the heat of the moment. And that, right there, is the ultimate question. This isn't a crystal ball, it's a roadmap. A professional trader's edge isn't about being right all the time. It's about having a plan for when they are right, and just as important, a plan for when they are wrong. The preparation is done, now all that's left is execution.